Hey, this is Matt from Deal Camp again, and we're talking about this series on the top ways that people lose money whenever they buy a business. So a lot of people come to us and the big worry that they have is, hey, I am all about making tons of money through LBOs. It sounds like a great idea, but I don't want to lose a lot of money either. And this sounds super risky to me. I'm really uncomfortable. And so this video series is just about addressing some of the ways that people handle that risk to see if this is appropriate for you. So we talked about, there's another video floating around out there that'll probably be linked in the show notes that's about using too much leverage. And this is one of the big ways that people blow themselves up. And hey, I was part of that camp. And so that's a big reason why I'm teaching this today, is because my first acquisition didn't do so hot. But today we're going to talk about paying too much for an acquisition. In another video, we're going to talk about buying a business in a bad industry. As Warren Buffett says it, whenever a great manager and a bad business meet, it's usually the bad business that wins. And so this is just a little lesson learned that we'll go through. But today, let's talk about paying too much. And we're going to go through two different reasons why people pay too much in the mechanics behind it, just to show you some of the tools that you should be using if you're going out there to buy a business, especially when it comes to valuation. So number one is optimistic projections. Human beings who are wired up to go out and buy companies are usually optimistic by nature, from what I can observe. And so whenever they go to buy a company, they usually have this grand plan of how they're going to improve all these different things, and it's going to be so easy, and we're going to sell a whole lot more, our margins are going to be a whole lot bigger, and everything's going to be great. And there's going to be no economic collapse. There's never going to be employees who are key to that plan who leave. Like, there's all these things that, they're not thinking about whenever, and they're not considering how hard it is to actually grow a business whenever they buy it. So their projections often look like this, where you've got maybe slow growth in cash flow over time. And then suddenly, whenever they buy the business, it's going to skyrocket like this. Now, there are scenarios where that happens. It really does happen. And there are people who are really good at this. But if you've never done it before, I would caution against thinking like this. And I would definitely ask you to avoid not baking that into the projections that you use whenever you're thinking about how to value a business. Instead of being optimistic, I want you to be conservative. And this is a big, boring word that will keep you out of trouble. And so it's okay to be conservative. It's okay to say, you know what, I think that this year is going to be, that's about all the growth that we're going to have. And I'm going to value it off of that year's cash flow. And for small, boring businesses, like what we deal with, this is how we do it. And deals get done every single day based off of this. They don't require these huge assumptions in how much value you're going to have to create for the business to make it grow. And so one of the things that's dangerous about this, that gets into number two, which is not understanding valuation, is most of these valuations, especially like with venture capital, if you got a business that you've got to grow at this really fast rate over a long period of time, a lot of times all the cash flow that they use to value this business, remember, valuations are done in most parts of finance using this model called the discounted cash flow method, which is actually not a great method to use, oddly enough. We'll get into that in some of the more advanced courses. But big problem with the discounted cash flow method, especially with fast growing companies, is that most of the cash flow that those models, whenever they're running their Excel models and doing this discounted cash flow method, most of the cash flow is way, way, way out in the future. And there's this thing called, and it's tied up in this terminal value, this thing called the terminal value. So it may be like 10 years out in the future that they assume that they're going to reap this big harvest of cash. And so all of their models have this really long-term view that is based off of this terminal value. And here's the problem. This is what's happened with interest rates. So if you look back over most people who are watching this video don't remember how high interest rates were back in the 80s and in the 70s. But if you talk to some people who lived around then, it wasn't uncommon for somebody to get a mortgage for 15% and be happy about it. There's a period of time whenever people were really doing that. And long term, the average 10-year treasury rate's about 6%, and we're way down here. We're like 3% territory, and maybe moving higher, very likely moving higher. And so what happens is whenever we've been in this super low interest rate environment that we haven't seen since right at the end of World War II. And so what's happened is we've had all of these businesses that have been valued off of these artificially low interest rates. And this is one of the reasons why there's this huge sell-off in like SaaS companies and fintech companies and all these VC-backed businesses, because whenever your 10-year treasury rate goes from 2% to, let's say it goes up to 6%, or that's where it's headed, so just 4% delta. And these guys know that they've got to have this thing called an equity risk premium. It's basically like whatever the risk-free rate is, let's call it the 10-year treasury. Above that, you need a certain amount of spread. It's got to be worth your risk to be able to go in and buy these startups, right? So that's what that equity risk premium is. It's basically like, hey, we're taking risks, so we need some extra return in return. So just going from a 22% discount rate, it's what they use to do this discounted cash flow. They basically use a discount rate to discount the cash flows by a certain amount every year. A 22% discount rate and a 26% discount rate, just the difference in 4%, in about 10 years' time equals about a 30% decrease in the value. So like if you started from here and your assumptions changed, you got to here, it's 26%. Your investment loses like 30% of its value whenever that market changes. That's why there's been this huge sell-off, right? So you not understanding that, and you having these really rosy projections, and you not understanding where you're at in history, whenever this happens, you lose money, right? You don't control your own destiny. So this is another reason why we buy really boring businesses that have really stable cash flow, really sticky customer relationships, where it's easy to raise the price. Nobody's going to argue too much if I got to raise the price by 5%, right? That's a great business that you can use some leverage on, that you can do an LBO on, and not probably lose your shirt if you know how to manage things well and you don't do these other mistakes, right? So that's what paying too much is all about. Having too optimistic projections and not understanding valuation. So hope that helps, and I'll see you in the next video about buying businesses in bad industries.